full employment. And so it doesn't mean we can't have some changes to the labor force, but if we look at unemployment broken down short-term versus long-term, if we look at the skills mismatch that we've noted previously, we think that even if there are workers who could come back, we are dealing with an economy that more or less is going to start about full employment. Unemployment about 4.25 to 4.5 seems consistent with that number. We also think there's continued churn in the labor market as this occurs. That's going to help productivity. That's been one of the missing items for the past 5 years. An upswing in capital spending should help with this. And in particular, we're focused on corporate profits. We're focused on profits because they're a good leading indicator of the economy. And our bottom line is we think this is going to be a good time to be a profit-making enterprise, partly from natural cyclical factors, partly from global factors, and partly from policy factors. So S&P earnings were about $118 for the past 3 years coming into this year. I think they'll be $124 this year and $135 next year. That's the foundation of what we see going forward. So it is rare for an economy to accelerate in the second half of a business cycle. When you think about the natural pool of available labor as that starts to change at full employment, that would make some sense. It can happen, but it requires output per hour, it requires productivity to kick in, and we think that happens. One, because monetary policy won't become burdensome anytime soon, and fiscal policy should become more accommodative. And we're particularly interested in the interplay, the interaction effects between monetary and fiscal policy and how that can play out. So in terms of the U.S. economy being at full employment, here's the headline unemployment rate, which we've looked at before. Just eyeballing this, you'd say we're in a zone that seems more normal than not. If we look at alternative measures of unemployment, like the U6 is commonly cited, that's also come down quite substantially. So this is our starting point. We're dealing with an economy that is starting to look more normal, but we're dealing with an interest rate environment that looks very abnormal. What we are seeing at full employment is labor share start to rise. This is corporate compensation, which is wages, salaries, and benefits as a share of corporate GDP. This has bottomed and turned up. I would note that this chart is very autocorrelated, has a lot of momentum to it. It makes only a couple moves in any cycle. And once it starts moving, it usually keeps moving. Once you hit full employment, which we'd say this would support, usually you keep moving in that direction. You start a cycle with a falling labor share of GDP, you end the cycle with a rising labor share of GDP. Somewhere in the middle you turn, and we think we've hit that turn for this cycle. We've hit it at a very low number. We hit a record low in terms of labor share of GDP this cycle, but for the last few years we have started to rise off that low. This is average hourly earnings. I used one of Mr. Dunkelberg's series here, the percent planning to raise worker compensation. This had led average hourly earnings by about 1 year historically. This cycle it's taking twice as long. So whereas before you might have surveyed small businesses and they say, yes, we're going to raise wages, they would wait till the next annual review period to do it. So you had that nice lead. Here it's taking 2 years instead of 1 to actually get the raise. So you need 2 good reviews to get a pay increase, not just 1 anymore. But it is still working. And the survey leading by 2 years would say that from here we probably have bottomed in terms of wage gains that are going up with some momentum. The number's not high because productivity's been low. Wage growth does not look strange if you look at how low productivity has been, and as John mentioned, how low inflation's been as well. But from here we're probably heading in this direction. Some things that will help. In terms of churn in the labor market, this is the number of quits from the job opening and labor turnover survey, the JOLTS data. I think this should be unidirectional, because I doubt somebody quits their job to go to a worse job, should quit to go to a better job. We know these are not layoffs because jobless claims are not moving, so these are voluntary separations, and that unidirectional property of this series we find encouraging. This is a number we just got last week with the household surveys. This is flows into employment, and we're looking at those who are going not in the labor force to employed. This is a pretty big leap here. So we like this type of mobility in the labor market. We like this type of churn. Again, this is something that can help with productivity, which has been low, to do a little better as we go forward. So Productivity's already started to turn up some. We got pretty close to zero for about 4 years up until last year. And I would submit to you that zero is probably the lower bound for productivity growth over any extended period of time. If you just do what you did last year, you get zero. So it's really strange to have negative productivity growth year after year. You could have it for a short period of time if you have more regulation, more security, something of that sort. But we can't come up with a good reason why you'd have consistently negative productivity growth. So we're at zero. Zero is the lower bound. Which do you want to bet on, up or down? I think the better bet is up. And we've already started. We've already started to see productivity do a little better. We think with more churn, there is more to go here. CapEx will help as well. So we've seen how low fixed investment has been. Of all the models we have, some of the fixed investment models are the ones that have missed the most recently. So if we look at some of our regression analysis, the ones that are off the most right now usually relate to U.S. investment to the downside. We should have been growing about 5% instead of getting flat readings. But given that, we have to decide if we have a broken model or we have pent-up demand. And we're more inclined to the pent-up demand side, partly for the reasons we've seen before on business confidence. So we looked at small business confidence in the other charts. This is more of a large business confidence series done by the Business Roundtable. So this is CEO confidence. It's not quite as extreme recently as some of the small business numbers, but it's also up, and it held its increase this past month. And so this leads capital spending by about 3 months, about 1 quarter. So again, here's a reason going forward we should see more CapEx combined with more churn. We think that yields more productivity. So do we have to worry about this getting interrupted by some sort of policy? We have had central banks move to tighten. We had the Fed move to tighten. We had the Bank of Canada move to tighten this week. There's some talk the Bank of England might be thinking about it, though I'm not so sure there. Eventually, the ECB will have to talk about tapering QE. They're still easing, but less so. So if we're going to see this happen, I think there's a distance to go before we have to get too worried, partly because even if we are normalizing, we still have negative real interest rates in much of the world. So this is the Fed funds rate minus the core PCE deflator to calculate that. And Samuelson's quote was, if you have negative interest rates forever, you could justify leveling the Rocky Mountains to save on the gas of driving across the country. So at negative rates, just about anything is profitable at some time horizon. And so yes, rates are going up, but they're not going up much. They're still negative in real terms. And so even though we've had some marginal change in the profile of global central banks, I'm not too worried about that interrupting this story. Also, while monetary policy is tightening, we do see, at least on the business side, a change in fiscal policy. And we expect fiscal policy to help boost 2018, especially 2018 earnings. So we're not making a claim that all policies are good or bad. We're simply saying what is going to happen is probably good for S&P earnings. And if that's the case, I think that has economic implications, because while you have more earnings recessions than you do economic recessions, it never goes the other way. We have never had a situation where you've put the U.S. economy in recession with earnings up. You only go into recession when earnings are negative. I think it makes some intuitive sense. You fire a lot of people when your earnings are down, not up. And so we would typically talk about a monetary offset to fiscal policy. So if we did fiscal policy at full employment, we'd expect interest rates to go up and get a monetary offset. We're thinking about inverting it this cycle. I'd rather talk about a fiscal offset as easier fiscal policy comes about that helps absorb some of the interest rate increases we're seeing from central banks. So let me make a couple comments on QE, then I'll finish and we can go on to financials. QE is not exactly helicopter money, but I'm going to use the helicopter picture just to make it simple. So if you think of QE as creating excess reserves at banks. So the helicopter's dropping money, but the helicopter's sitting over a bank. Balance sheet drain would be the opposite. You flip it over. When we combine monetary and fiscal policy, instead of dropping money into a bank, creating excess bank reserves, it's more like you're dropping money into the treasury. And you can go build bridges, do infrastructure, do tax cuts, you can do a variety of different things. But I think this combination, this interaction effect between monetary and fiscal policy is really what we should pay attention to here, and what gets underestimated. Where the question I'd leave you with is, which would you rather have of the cars out here? Do you want to car with $4.5 trillion in gas but no transmission? Would you rather have a car with $3.5 trillion in gas because you did some balance sheet drain but the transmission works? Or I think what fiscal policy is going to help do over the next year is repair the transmission mechanism that has been missing for a very long time, really upwards of 9 years at this point. So that's where we see the U.S. economy. An increase in capex, an increase in labor market churn gets us productivity, productivity gets us profits, and profits keep the business cycle going. Thank you.
Luckily, I have no PowerPoint. Years ago, Jim McGregor at Abernathy McGregor, who's one of the best PR men in New York City, said to me, "Chris, never use PowerPoint. Look your audience in the eye. Include people like them in the story if you can. Include a dog. And they'll remember what you say." And I must tell you, that is probably the best advice I've ever gotten as a speaker, because when I appear at different events around the country, I usually get pretty good scores, unless, of course, I just depress the hell out of everybody by getting too realistic about what's going on. I come to this conversation as a member of the board of the GIC, and I want to thank our sponsors on behalf of the board for doing this for the number of years that they have. It's a really interesting event, and it's always a good reason to come out here and enjoy the most beautiful part of the country in a great time of the year. I'm known as a bank analyst and an author. I'm really a historian. And I like hanging out with economists because I like the confluence of historical facts with the analyses of data series. And the one thing I've learned as a bank analyst, particularly in the last few years, is that you can't go too far back in time with your data series analysis, because the qualitative aspects of the data change. It's not the same. Piketty, in his great book, committed a terrible error. He did a wonderful job of gathering the data, but then he went and jumped to these monumental conclusions, going over centuries of time, never really allowing for the fact that people change and societies change. And in the same way, the Fed has changed. I worked at the Federal Reserve Bank in New York before we had cell phones and personal computers. My first assignment, in fact, was looking at the overseas investments of a bank called Citigroup. And that's how I learned about them. My comments today are based on a blog post I did on Monday, and I also did one today on bank earnings where I talked a little bit about the credit situation. Prior to the crisis, when the Fed wanted to make the economy go faster, they would drop interest rates. And a variety of things would happen, primarily in the mortgage market, but across all of the different asset classes and credit. And you would get borrowing and spending, and the economy would go faster. But since 2008, the Fed has added an additional factor, which is open market operations, what Chairman Bernanke characterized privately in the board conversation as massive asset purchases, but the good folks at the board decided to call it quantitative easing. And what they did with this was not just change the price of credit, but they removed assets from the marketplace. And so they're essentially forcing investors to put their money somewhere else. And, whereas in the 2000s, the primary focus of the exuberance was the residential housing market, this time around, it's been commercial real estate. If you think about it, what's happened both before the crisis and after in terms of Fed policy is remarkably similar. Drop interest rates, add accommodation, and get the party started in terms of credit creation. The only trouble is that once the party is over, the hangover and the aftermath largely wipes out the profits and the income that you thought you generated before. And you very definitely see this today in the banking system. Banks have come through the crisis. They have been constrained by policy. There's all sorts of new regulations that have been put in place that say, don't do this, do that, et cetera, et cetera. The mortgage industry in particular has been under constant attack since the passage of Dodd-Frank in 2010. And what this has done is it's created kind of this bizarre situation where, on the one hand, we have a shortage of investment opportunities because of regulation, because of what the Fed has been doing in the bond market. For example, they were buying all of the issuance of Fannie Mae and Freddie Mac every month. There was no net issuance that investors could buy. And housing is a $10 trillion market, but the Fed was literally taking all of that paper out, plus they were buying treasury bonds. And so over time, what happened in the credit market was, as you might imagine, credit spreads tightened. Crappy companies could go out and raise money at the same cost as good companies. And you've seen over even the last year or so, less than a year since the election of Donald Trump, the 10-year treasury bond spiked almost half a point, but credit spreads for corporate debt tightened. When was the last time we've seen something like this? The answer is never. You also had a situation where during the period of Fed intervention in the bond market, you had stocks and bonds perfectly correlated. I can't even remember the last time we saw that. It's an unnatural event because it implies that they're the same. And really, going back to the point that was made earlier by our colleague about zero interest rates and flattening the Grand Tetons, yeah, that's right. If you have a zero interest rate as your discount, then obviously the value of the equity is infinite, right? If you're discounting the earnings. So where we are today with U.S. banks, very simply, is they have, to some degree, expanded credit, not so much in residential housing, but in many other sectors. One thing I mentioned to Manuel was that the reason we don't have any construction in single-family homes is that banks have been told, don't lend on single-family construction and development, period. The portfolio of U.S. banks right before the crisis for that sort of thing was $600 billion. You know how much it is today? A little over 300. So those short-term loans got paid off or they got charged off, and then the regulators told the banks don't make any more, so they don't lend on dirt. It's only recently started to turn up. And if they did do construction lending, it was on multifamily. It was on apartments, high-end apartments, or high-end homes in some cases. Look at Texas. Texas has been booming in terms of home construction. And I think the distortions that you see in the banking industry and the credit portfolios of banks and also bond investors is rather striking because the metrics today look marvelous. They look absolutely amazing. They're too good, in fact. If you look at multifamily housing, for example, which is a relatively small portfolio in the banking industry, loss given default, in other words, when a loan defaults, the bank takes over the property and they sell it, right, is negative. What does that mean? It means they're making money when the customer defaults. Somebody shows up and buys the property for more than the balance of the loan. Okay? You particularly see this in major urban areas because everybody's trying to buy commercial properties. So-and-so runs out of money while he's building his building. Another person shows up and takes the bank out of that exposure with no loss. We had this a while back in 2005 and 2006 in residential housing. Countrywide, Bank, Washington Mutual, all the big go-go mortgage lenders were reporting negative defaults in 2005 and 2006. That's bad. That's what we call a red flag in the world of analytics. And so today in commercial real estate, multifamily, a couple other asset classes, when you look at the data from the FDIC, it's literally too good. And I would suggest to you that what it shows us, what it illustrates, is that the unfortunate downside of the Fed's efforts to move the economy, get credit growth going, get spending and consumption going again, is that we hid the cost of credit. In other words, you don't see the cost of defaults today because there's somebody there to take the bank out whole. We saw this in energy in 2015. I covered a couple of energy lenders when I was running the financial institutions group at Kroll Bond Ratings, and one particularly that I've talked to a few of the folks here about was Cadence Bank, which is run by a wonderful guy named Paul Murphy. Used to work for Amegy, which is a subsidiary of Zions. And we thought 2015 was going to be a mess. We were really expecting to see default rates go up, but it didn't happen. Why not? Well, the bank asked the owners of many of these fracking firms and the services firms to put up more equity, and they did. In fact, there was a line around the block. The private equity firms doubled down, put more capital into that sector, and the default rates were maybe a third of what we were expecting. That, I think, is ultimately a function of what the Fed has been doing in the marketplace by shifting the risk curve and by deliberately manipulating the credit preferences and the risk preferences of investors. We have created an environment where companies that don't make money can fund themselves. You know, Tesla, amazingly enough, is not just funded with equity, it's funded with debt. This is a company that will never make money. I just came out with a book on Ford, by the way. I'll give you a little plug. It's called Ford Men, From Inspiration to Enterprise. When Henry Ford started his company, his business partner, James Cousin, said, Henry, we're going to sell cars. Henry wanted to tinker. He wanted to make it perfect. And Cousin said, no, I'm putting an ad in the newspaper. And when he did, they were buried in orders. In fact, that's why you had the proliferation of auto firms during that era, because everybody wanted a car. If it had 4 wheels and a motor, you could sell it. That's not the case today. The auto market today, most of the global automakers don't even earn their cost of capital. And you saw that chart earlier about how cyclical the auto sector is that Bill was referring to. Yeah, it is the most viciously cyclical industry I can think of. I asked Bill Ford once, I said, if you could get all the family's money back, would you put it in the auto industry given how brutal and how cyclical it is? And he said, oh, of course. And you expected him to say that. But I'll never forget when his cousin Charlotte got up at an annual meeting and thanked Bill for taking over the company when the industry was going through some very dark days. And she said, we never realized just how brutal and how difficult the competition in this industry is. So look at Tesla. I mean, as I said before, this is a company, if they stick to what they're doing, maybe they'll come up with something else. I don't think they'll ever make money. But the shift in the credit markets, the shift in preferences on the part of investors has enabled this. There are many, many other examples you can see in the equity markets. The other interesting thing is that if you look at the equity markets, IPOs have basically dried up. In the first quarter of this year, we did $50 billion, or excuse me, all of last year, we did $50 billion in IPOs. Much of the attention in the market was actually share repurchases, 3 times that number, by the way, over $100 billion in one quarter alone, that were funded with debt. So companies, seeing how cheap debt is and how easy it is to issue debt, have simply been buying back their own stock with debt, and in many cases they pay out more to their investors in dividends than they make. You know, Citigroup, for example, they're actually going to be paying out more in dividends subsequent to the bank stress test that the Fed just concluded than they actually make. So I think, unfortunately, when people say, gee, Chris, what's happening in the credit markets, we're kind of hopefully heading back towards something resembling normal. But it's going to take a long time. And my fear, my supposition is that there is an awful lot of loss embedded in the portfolios of banks and also bond investors that you can't see right now because there's somebody there to take them out. And if that changes and you start seeing investors back away from things like commercial real estate in the major urban areas, other asset classes, especially multifamily. New York City, by the way, is a great example of this. We have more high-end real estate than we know what to do with. We have more coming online in the next couple of years. And I think it's going to take a decade to work it out because they just don't have enough people who want to put $10,000 a square foot down for a condo on 57th Street and 6th Avenue. There's been 2 foreclosures in this building. The buyers for the foreclosed property have all been in the $5,000 to $6,000 square foot range. So that's the real price of those apartments. But the availability of capital pushed the valuation of these assets up way beyond the possible cash flow for renting them. Remember, we used to have that test. If you looked at a property, you say, what could I get if I rented it? We don't even talk about that anymore. That's old hat. We just say, oh, well, we go out and finance it and build it. So I think that, to me, what I see in the credit markets today is that we've been through this painless period, thanks to the Fed, thanks to low interest rates, thanks to quantitative easing. But at the same time, eventually, if we don't maintain that level of stimulus, then we'll revert to the mean because, as our colleagues were talking about before, we haven't seen income growth commensurate to validate those prices. We're not seeing income growth in New York of 20, 30, 40% annually to keep up with the real estate market. And so what I would say to you in conclusion is that I'm not looking for the end of the world by any means. I think the U.S. banking system's in great shape. But I do think that you're going to see credit costs continue to climb this year and next year, and you're also going to see that in the bond market. When this ripens sufficiently that it rises to the top of public mind and people actually start talking about it in the evening news and the public marketplace is hard to guess. But what I will tell you is that there is a cost to credit. You can never pretend that lending somebody money or making an investment has no downside, and that's really what we've been assuming for the last couple of years. So I'll leave it there, and I'll look forward to your questions.
So I'm supposed to have a clicker?
Yes, sir. It's right there.
Well, let me remind you, I came into this business before they invented these things. So, how do I work it? The red one? The green one, okay. Okay. There's a reason for this cover. That's the name of my firm now. But there's a message in here. This is my answer to that question, where will the S&P be in the future? Early in my investment career, I worked for a gentleman who was a mountain climber that constantly reminded me that he had never climbed a mountain that didn't have a peak. So I worry about how high we are. So the next slide. That's my view of what the investment landscape is like today. My clients keep telling me that's me. I hope you'll look carefully. There is a safety harness, which I think every portfolio manager should have. Beware of risk. But the point here is I think we're in an environment where everybody is working so hard to generate a return in a low return world that there just may be more risk than what we are thinking about. So next page. I don't know why this is there. One of my partners snuck it in there, I think. This is a bio. I think he wanted to put it in there so everybody could know that I'm not a young Turk anymore. But the point here is I may be the only person in this room who've experienced 40% declines in the market. If you've done that, you don't forget about it. I think it is something that we should reconsider today. So the real issue here is how you manage a portfolio, how you as a money manager should act in a period of time where we're up there with that helicopter. Okay. The stock market. As you can see, we've come a long way. I get nervous at these levels, and I think we should be thinking about not just how you get a return, but what could go wrong. Now, there are a lot of us that are nervous Nellies or whatever. A disagreement already. I accept the view that one of the reasons the market is up here is, look, we have a Strategist firm has done a great job of articulating why we're here. Look, we have a synchronized worldwide recovery. We have an improvement in profitability. We have low interest rates, typically called the Goldilocks environment. The next page is how far we've gone in this stock market. This is a chart done by Jason Trent at Strategist, which helps me keep perspective. The market is now up 258% since March of 2009. This is the second longest bull market in history. I could redefine it where we're almost the longest. Now, how did we get here? It's readily obvious we got here because the central banks wanted it to be here. They put in more liquidity into the system than we ever would have thought. It has continued longer than we would have thought. So I think we have to be wary if something changes. Here's another way of looking at it. Look what they've done, liquidity versus GDP. You could look at this optimistic for financial markets. If you're an economist, I think you would be pessimistic. It didn't do a whole lot for growth rate, did it? So I think this means that our predictability is somewhat less. Now, what I begin to worry about, the central banker's rhetoric has begun to change. You see what the Fed is talking about, Janet Yellen, Mr. Fisher. We have Mr. Draghi trying to do Greenspan speak. Maybe I'm going to tighten, maybe I'm not. There's only one person I think we can have confidence going forward, and that's Mr. Kuroda of Japan. He's not going to change. But there's a significant change possible going forward. Does my tailwind shift to becoming a headwind? The next two charts are just a reminder where we are. Look at this picture of interest rates. It's something I keep in mind. I went back and I calculated in my investment career, the average PE in the market is 16.7 times. Doesn't sound so terrible, does it? The average interest rate, 6.5%. I worry, is the stock market a prisoner of the bond market at this stage? So it's important, as far as I'm concerned, everybody's right that interest rates aren't going to 3%. That could be a stumble. Short rates, same thing. Unbelievable how low it is. But I think it's so low now it creates a level of unpredictability. What I would argue the central bankers have to do to successfully bring this balance sheet down successfully is to really know how all money flows in the worldwide economy. They have to understand how bonds are bought, how they're sold, who has to do it, who doesn't have to do it, whose situation has changed. Does the Middle East still buy as many bonds? Did Japan buy as many bonds? Does China buy as many bonds, et cetera, et cetera? It sounds to me like a very complex process that will be much more difficult to manage than they think. Oh, I'm sorry, I didn't. Here's the interest rate level. Next chart. I just threw this in here for fun because I think it's a good anecdote about where we are. Is this what the central bankers wanted this money to be used for? To try to take over or to restructure the largest food company in the world? I don't think so, because I don't think that adds anything to worldwide growth. So I think it's useful now that you have this situation to sort of cause a rethink. Now, to me, this is the most important chart in this handout. If you went back in history and you looked, when you buy equities at this market level, what's the 10-year annual return going forward? As you see, it's in the box. And that box of expected return going forward is usually 0 to 5%. I don't think that encourages me to take the same risks that people I see are taking in today's market, even though they may think they're not taking it. And there's another chart, unfortunately, which didn't make the package, but when you're in that environment, the number of double-digit declines in the marketplace accelerates. If you look back in history, you would find during those periods of high valuations, low potential returns, 2 out of 5 years you get double-digit declines. I don't think the world is prepared for that. And the frequency of double-digit declines increases. Got it. An example of that is what the world is looking at. I'm suspicious of volatility numbers, but I'll take it as some kind of measure of what's going on. Here we are, what I think uncertainty is rising. And if volatility is is a good example of risk, it's declining. I find that an uncomfortable situation. Now, here we go. There are 3 things I'm going to talk about going forward, which I think are in the process of change that could create maybe scenarios that we are not thinking about at the moment. The first here. This presumably is what the Federal Reserve would like to do. Reduce the balance sheet. Okay? let's take them at their word. Maybe they can successfully do it. But I think there are a series of complications. Look, the next complication, 50% of the U.S. Treasury debt matures over the next 3 years. That's a lot of money to be shifting in a short period of time when conditions are changing. Could that create some dislocation somewhere? And now, sort of a statement here. I saw this 2 days ago. Jamie Dimon is over in Paris, and this was his comment about the Federal Reserve's ability to reduce the balance sheet. It first annoyed me greatly because I gave a speech in Shanghai in early summer, and it looks like he quoted me almost verbatim. I'll let him off this time because I think there's a better quote that sums up the situation. And that's this. This is the way I'm going to think about the contraction of the balance sheet going forward. Now, just a little insight. Richard Fisher said this on CNBC. He was quoting Herb Kelleher, who was the person who developed Southwest Airlines to the level it is. And if any of you knew Herb, he enjoyed a good drink. But I think this is a great way to think about the dilemma going forward. Now, this is something that's hard to read. Take some of an explanation here, because what I'm trying to do is to go back in history. Chris is a historian. I'm a historian. I do a lecture in financial history at the Darden School, University of Virginia in Charlottesville. The reason for this chart, I like to go back and make comparisons. One of the 40% declines I went through was 1972-74. This was in the middle of what we call the Nifty 50. In 1969, the Ford Foundation came out with a study and said, all institutions are grossly underweighted in equities because the equity return is 9% and bonds only give you 5 or 6. The next 5 years, 100% of institutions' cash flow went into equities. And they went into what they considered the safest, the blue chips. They were the growth stocks at the time. They went from 20 to 23 times earnings to 50 to 50 times earnings. Today, I think we're seeing a similar phenomenon. I don't know how we should describe the Alphabets and the Facebooks and the Comcasts and the Microsofts and all these, quote, fast-growing companies. But the reason for including this in here, as the world concluded they were higher certainty of meeting their growth rates, they took their valuations up. So I think what the market is saying, I'm willing to strive for better return, but I do demand higher certainty. And it's absolutely fascinating that 5 years ago we would have said the higher certainty is the consumer staples sector. Well, these companies now are considered less risk than the consumer staples. So the point is the market is not getting carried away at this peak. It still has some concern about uncertainty. And the reason I say that is that can manifest itself very quickly. This is just a picture of what the big growth stocks have done. I include this in here because I'll just give you an anecdote. My whole investment career, I've been a value manager. I love to buy things cheap. I love to buy things that people throw away. I love to buy things that I think are seriously mispriced in terms of their assets. Today, my largest position is Google. My second largest position is Comcast. My third largest position is Microsoft. My fourth largest position is Apple. I have nightmares every night. But the reason they're there is 3 years ago, people did not give them credit for their potential growth rate. But I don't know how far this can go. I welcome all the advice. Is it time to leave or whatever? But if you make a comparison to the past, and you don't think we're going to a 3% growth rate, their valuations can continue to creep up. Now, next page. It's interesting in today's world, we have a phenomenon where we talk about, it seems like this occurred in the last 2 years. We have hard data and we have soft data. And I don't know why we decided to divide it up, but I think it's just so we can make more forecasts. Just so I learned early in my investment career that I would not be a success if I totally depended on my forecast. I spend all my time not forecasting, but trying to understand what is happening and what to do with the data. Now look what we have here. If you go back up until 2 months ago, everybody's saying everything is fine. Look at what's happening to the Citibank surprise index. Don't ask me how to construct it, accept it for what it is. The correlation was very fine. Look what's happened in the last 3 months. This index is suggesting things aren't as good as everybody says they are. So my advice, it's time to be wary. And recently, the next chart, we saw some degree of anxiety. Something changed in the bond market. There was a quick change in the equity market. I don't know if this is a 1 or 2 day phenomenon, but I think it's something to begin to think about. Things are changing. And if things are changing, change how you think. Now, I included this chart in here, but it's too hard to read. Basically, if you look at the top column, you'll see once again, here's an example of high valuations. But the bottom chart is probably more important. It's the reason why we keep trying to do this every day. We have a bond yielding 2.32, 10-year. We have an equity market with free cash flow yield of 4.2, 4.3. Low historically, but still significantly better than the bond. So I think you have to keep trying. But I'm going to be one of those people, I'm not going to be fully invested. I'm only going to invest where I have conviction. The next thing to worry about. Okay, the central banks are changing. Look, we've had a significant improvement in corporate profitability. We had 5 quarters decline. We started an increase in the first quarter. In the fourth quarter. The first quarter was much better than everybody expected, plus 12 or 14%. So we have a tailwind. How far can that take us? But I would argue we are at that earning stage where it has to continue. And the next chart gives me some trepidation about saying, will it continue? 5 minutes? Okay. We're at record profit margins. Most people's forecasts demand that continues. And just let me go through, since I got the pull sign, I'll go through it here real quickly. I'm a skeptic about profit margins continuing to rise for here for this reason. First, here's the contribution of sectors in the S&P. Now let's sort of go. Information technology, I have no judgment about. Healthcare, everybody's extrapolating things are okay, but this quotes a study where you could see a reason for healthcare revenues decline $390 billion. This is an industry that has lived off of 9% price increases for a decade. I'm suspicious that can continue. The next thing we have, I don't know when this happens, but I talked to the dean of the Darden School, who was the head of research at McKinsey, who said, you better start thinking the internet is the only thing I have ever seen not regulated. And I was the head of regulation consulting at McKinsey. Don't relax. My advice here too. Another reason I don't sleep well at night, because I own a couple of those stocks. The next page here. The Amazon bomb. Don't relax. I think there's one implication possibly from what Amazon is doing. Okay, they're going into the grocery industry, an $800 billion industry. It's a big one. We've already begun to see household products struggle to increase prices after a decade of annual price increases. I would argue going forward, look for food companies and allied types of businesses to struggle in terms of increasing price. So I begin to doubt their profitability going forward. And so I can, if you went back to the original sector, I can begin to question 40% of S&P profitability. It may be okay, but I have uncertainties about it. Now quickly here. This next, where am I? Oh, went too far. How do you go backwards? Yes. Okay. Anyway, we'll use this chart. There's one thing that people don't talk about in this environment. I'm a believer, I learned early, money flows were the most important thing you needed to understand. Money flows are what moves stock prices. This is, to me, one of the fascinating market cycles. The biggest buyer in this stock market cycle was the corporation. They averaged $400 to $500 billion repurchase every year. At this level of the stock market, at this stage of change, they have begun to reduce their purchasing, down 17%. I think it will decline, continue. If profitability peaks and declines, it will continue to decline. So somehow or another, I have to make up that amount of money. I know there's a recycling of money from whether it's the individual out of bonds and equities, whether it's out of mutual fund managers to passive, which means there's some increase. So I think there's some doubt about the money flow going forward. Now, just quickly, since I'm running out of time here, just two things I would like to mention. What could go wrong? I worry there can be an outlier in what I think is a less liquid market than we've had historically. One is, this is done by a young man at Strategist who's great at the political side. What happens if we begin to get indications that the Democrats will take over Congress? My answer, thank you. This chart suggests it's a possibility. Now let me bring in something which Chris, as a historian, you can appreciate, I appreciate. This is 1962. Probably most people don't think about it, remember it. In 1962, there was a confrontation between the steel industry and John Kennedy. After a labor agreement, Roger Blau went to Kennedy and said, I'm raising prices 3%. And John Kennedy said, you can't do that. Well, in the next 2 or 3 months, the stock market declined 23%. What was there a fundamental reason for that? I just think there was a structure of the market at the time that couldn't handle that. So what I would argue is that we're at a stage, there could be an outlier. There's less liquidity in the market. So you should plan in terms of your management of risk. There could be something that could happen quickly. Or as somebody said, we are at that stage where a small event could have major, major impacts. And now, just for the last part, okay, I worry about China. Everybody worries about China. We worry about China because it's almost a black box. I worry when they're trying to control their financial system. They're worried about too much risk in their system. Maybe they can manage it. Maybe they don't get it right. And now for the last point, this will sort of sum up where I stand. I think this is what we're struggling with every day. Most of those people running, they're people trying to get a return. And the question, do we run into the wrong thing? So thank you very much. I enjoy.
Okay, maybe we'll we go ahead and get some questions from the audience. Any questions? Yes, sir.
Anybody who wants to address this on the panel, there's been a lot of talk of passive investing and the amount of ETFs and index funds that have been created. I saw a statistic the other day that there's 5,000 index products, either ETFs or mutual funds, and there's only 4,000 publicly traded securities. So, is this the type of thing that's the tail wagging the dog? That's again something else that has been created because of all the massive liquidity, financial engineering. Can you guys address that and how that could affect the markets? And
well, I'll start. Manager performance, I think, has compelled investors to embrace index products because most managers don't do as well as the broad market. The interesting thing is we've never tested this passive structure in a down market, and I'd like to know what Dick thinks about that because, at the end of the day, These are derivatives, right? You just said it. A derivative, right? And a derivative is generally not as liquid as the underlying basis. So I think it's an open question. The sponsors are a point of weakness for some of these ETFs. And I know that there are concerns, but all of the big houses on the street are sponsoring them, and the question is, would they stand up and support them if they had to? So, yeah.
I'll add to that. There's one additional fact. You talk about the number of stocks. I don't know what the number of indices now is catching up with the number of stocks. So I think that is some statement about active versus passive and how you define it. But Chris went through this, and I went through 1987.
Yeah.
It's a question I asked. Do we have some conditions like 1987 from the standpoint of we had created a derivative product? Futures. We use futures to increase your equity exposure or some of your leverage. And then all of a sudden in 5 to 10 days, something changed and everybody had to sell. And what I worry about in ETFs is there's something that provokes people, they have to sell. Now, I got some data 2 days ago that says the behavior of the ETF holder is that of an aggressive investor. He goes there quickly to get a return, and if it does not work, because he is managing volatility for his clients, he has to go. So is there something that causes more people to say, on a particular day, a particular event, do I have to sell? And to me, that's the unknown. That's what I compare with 1987.
And just to add on to both of those comments, what the beta bubble, the indexation of the market has done, is remove price discovery. The algorithm in the ETF land is very simple. You give me $1, I buy all the stocks. Doesn't matter what the valuation is, doesn't matter, just buy it. It'll work the exact same algorithm the other way. When it's time to sell, you sell everything.
And isn't that the point, like you were saying about working out in real estate, there's no price discovery. Uber, there's no price discovery. It's not, it's a private company. Who knows what it's worth? That's across all asset classes now, isn't that?
It is, and then the leverage underneath it, to Dick's earlier point, right? We've removed so much equity from this market, it has to go up. I'm not looking for the stock market to go down, but I'm looking for the 10-year to go back to 2, because the overriding tendency in the market is still deflation. This is why I follow Italian banks, by the way. To me, that's one of the biggest pain points in the marketplace today is Southern Europe.
Other questions?
I guess to follow up with that, Chris, I'd be curious to hear your thoughts on expected global capital flows, either in or out of the U.S. as a result of the sovereign debt crisis that's unfolding, and maybe even the threat of international war.
Well, one of the interesting things about the QE period and the low interest rate period is that it attracted, because there were problems in other parts of the world, to be fair, right? We had an enormous amount of capital come into the country. Over 5 years, for example, from just China alone, we probably saw $1 trillion go into real estate in the U.S. and Canada. That's a lot of money. And it was mentioned this morning about how Chairman Xi had basically curtailed the ability of his citizens to take foreign exchange out and buy, that house in Vancouver or Los Angeles or what have you. But I think those flows are very important. And of course, the dollar's been weakening over the past few months. So, again, going back to the earlier comment, what is the rare event that no one expects that could change perception to make people want to cash in their chips and get out of equities and rotate back into those safe, consumer staples and bonds, even though the yields are lower? Because there's an awful lot of profit sitting on the table right now on the stock market. I think that's why, a lot of triggers are quite nervous. Because, you look at the run. I mean, Bank of America went up 80% from third quarter of last year to today, in part because the managers want to donate. They all increased their allocations to financials after the election, and they're still looking like they were in October. There's really no change in earnings or revenue profiles for most of the big banks. So it's definitely a perception issue, I think.
Don, let me ask you a question. We've skirted around and discussed the productivity issue. It's sort of a second derivative question. It seems to me one of the most undervalued or potential upside surprises to the economy is if we get a true cycle of deregulation. The Code of Financial Regulations is 180,000 pages. It was 80,000 pages in 1975. There are over 1 million single individual regulations that are codified. It doesn't take Congress or legislation to create deregulation. It's a change of person and how the existing law is interpreted, which I think we have probably seen in the last 6 months. Do you see deregulation flowing through? What economic factors are you following to see if that actually comes in so that we can get some more capital formation into the economy? And is there an unintended consequence that maybe the market's not appreciating?
Yeah, it's a great question because of what you mentioned with it being non-legislative. You don't really need an act of Congress to do some of these things, especially if you look at like Randall Quarles of the Fed being the vice chair of supervision. Energy deregulation is probably about maybe close to $20 billion of energy projects just being approved that were already on the table. There could be more there. So I think the areas you look are in energy and financials to see that. The scope could certainly be broader, and it would play into what Bill Dunkelberg was talking about small businesses who are really thinking about the next few years as being not just a place to make money, but to keep money that is made, and you don't have to expand your floor of lawyers or your compliance department any more than you already have. So if nothing else, it's not getting worse. And then I think the question is, does it get better? So productivity ran about 0.5% a couple of years ago. Last year was up to 1. You might get up to 1.5 on something like that, plus other things.
Chris or Dick, anything to add to that?
Well, look, if Richard Cordray decides to run for governor of Ohio, he's got to leave the CFPB by Thanksgiving, and there will be a big party the next day. I can tell you that everybody in the mortgage industry, and frankly, you'll see the stocks of financials pop. There's an event for you. They won't stay up because the fundamentals of the industry are so miserable right now, but boy, they'll be happy. Because that man has done terrible things to housing finance. I mean, if you're in the bottom third of the U.S. population, you can't get a mortgage today, basically, unless you're a first-time home buyer and you go to the FHA. That's about it.
Let me ask you a question. Goldman Sachs has this study out on banking deregulation, that what we're going to have could increase profitability, what, 17, 18%? Is that realistic?
Some of it can be done by fiat, by the people who run the agencies. Don is absolutely right. But a lot of it's embedded in Dodd-Frank, and they're going to have to deal with some of it legislatively just because, it's literally in the law. I think one of the most shameful aspects of that legislation is the abusive practices provision in Dodd-Frank that's been used to extract penalties from banks and non-bank mortgage companies with no right of due process. No notice, they just tell you to pay. And it's really scandalous. It's the embodiment of Elizabeth Warren, the puritanical punishment of American business. And, to the extent that the Trump people have put new agency heads in place, that's changing, and that's good, But as I say, look, people in the mortgage industry are not agents of Satan, but that's how they're treated. In the securities business, we're allowed to pay for order flow and referrals and everything else. In the mortgage business, if you're a lender, you can't buy a realtor a hot dog. You can barely talk to them. That's the regulatory constraints that they put in place. So a lot of it is you can do with regulation, but a lot of it you would have to go and change that awful law.
Okay. Other questions?
I think they're thirsty.
If not, I have one final, and Chris, I'll direct this to you. Fed's going to be shrinking the balance sheet. Shrinking the assets, but they got to shrink the liability side as well. What's the unintended consequence?
Look, I go with Bob Eisenweiss's view of this, our friend at Cumberland Advisors, who was head of the Atlanta Fed. The reserves went up because the Fed bought securities from banks. and they gave them reserves, and they can use those reserves any way they want. They're cash. If you sell the bonds, then the reserves go back down. The Fed wants to get to, I think, $1.7 trillion by 2024. I would tell them to go faster because, you know, the mortgage industry, thanks to the Trump bump, is down 30% this year on volume. The Fed could be selling $50 billion a month in mortgage securities. I would tell them to keep the treasuries because they want to have their portfolio back to pure treasuries eventually. And then the point you made earlier about the maturity structure of the treasury market, I don't know. I mean, what a fiasco that is. You know, Mr. Fisher, he's going to have to go into hiding because, you know, we need to be issuing term debt that's, you know, way, way out there instead of what we have today. But, you know, last point, I think the thing about reserves is misunderstood is it hasn't slowed down lending, but what it has done is I think it prevents interest rates from going up. You know, and if rates, imagine if the 10-year bond went to 3.5, Dick, the duration of the Fed's mortgage portfolio would double. Okay? There's no way you can have medium and long-term rates go up if they're sitting there with all that duration on their book. It's just not going to happen. That's a happy thought. Let's go have a drink.
Please give our panelists a big thank you.